And if you don't get this right, you could find yourself in a situation where fixed rates fell slightly once again this month, while variable rates pretty much remain the same. And there's more good news for mortgage borrowers because it looks like the Federal Reserve in the US is going to raise interest rates one more time this month and then signal a pause, which will finally put an end to the upward pressure on interest rates, at least for the time being. And if it looks like over the coming months, the inflation is going to continue to subside, then that could put further downward pressure on interest rates, meaning that mortgage rates could get cheaper. But before I get into all the details, my name is Nolan Matthias, and if you want to thrive financially, this is the place for you. So do me a favor, hit the subscribe button so more people like you can see this video. And as we reach closer and closer to that 50,000 subscriber mark, I really want to do something special for 50,000 subscribers. And I'm thinking about doing something with the charity, although I'm not sure what or which charity to pick yet. So if you've got an idea for an amazing fundraiser that we could do for a charity, or you've got a charity that you think would tie in well to this channel, put them in the comment section below. I always appreciate everyone in the community providing input on these types of things. Okay, so let's jump into interest rates, and let's start first by taking a quick look at the bond market, because the bond market is what mortgage rates are priced off of. And as you can see, if we look back on last month, the 5-year bond was at 2.943%. And as of right now, it's at 2.96. So it is pretty much the same as it was a month ago. And that is really good news for mortgage borrowers because that means that mortgage interest rates have pretty much steadied out. There hasn't been any big fluctuations up or down like we've seen over the last 18 months. But that doesn't mean that interest rates haven't gotten slightly cheaper, because they have. And as you can see from the bond market yields, there really hasn't been much of a change to the cost basis for interest rates. But as the spring market hits and it appears that the real estate market is in recovery mode, lenders are getting more competitive, which has led to interest rates coming down slightly across many lenders. So if you take a look at the 5-year full-featured mortgages right now, and again, 5-year full-featured mortgages, these are the ones that have all the bells and whistles. They have the lowest penalties. These aren't the big bank 5-year fixed mortgages that have massive penalties. These are the mortgages from lenders who specialize in mortgages, and because they aren't household names, they actually have to have better products than their big bank competitors. So what ends up happening with these types of mortgages is you get the best of both worlds. You get the super low rates as well as the full features and the low penalties that can save you tens of thousands of dollars down the road. Now, if you want to know more about discount versus non-discount mortgages, and I'll get to the discount mortgages in a second here, but you can also get my new book, Mortgage Secrets, by going to mortgagesecrets.ca. It's totally free. All you have to do is pay the shipping and handling, and I'll send this out to you. And it has a bunch of great information on discount versus non-discount or full-featured mortgages, as well as a whole bunch of other stuff you probably should know if you're going to be negotiating a mortgage. So insured mortgages, these are the least risky for the bank and tend to also have the lowest rates as a result, are now priced at 4.59%, which compared to the variable rates, which you'll see in a second, are significantly lower. And if you start to look at 20% down, now these are the mortgages that are most risky for the banks because they are those mortgages that don't have insurance but have the highest exposure for the banks. Well, you're looking at 4.89%. This is down from last month as well. And then getting to 25% down, you start to see as you put more money down, the risk starts to go away for the lenders, and subsequently you end up with lower interest rates. Those are now priced at 4.79%. And then at 30% down, you're looking at 4.69%. And at greater than 35% down, you're looking at 4.59%. Now, for mortgages that are uninsurable, mortgages that are refinances, mortgages on properties over $1 million, mortgages where you're looking at 30-year amortizations, the prices on these have come down quite substantially. They came down last month, but you're looking at 5.04. A month and a half ago, these were priced at almost 5.25%. Now, as you can see, there's a big discrepancy between the 20 to 35% down payment mortgages in the pricing and the uninsurable mortgages. That's because the 20 to 35% down payments have what's called back insurance. So this is insurance that the lenders pay for on your behalf so that they can bring down the pricing on the mortgages. Now, moving into variable rates, you'll be able to see that these have not changed at all since last month. Basically, at insured rates, you're looking at prime minus 0.9. So in other words, you're looking at 5.8%. When you're getting to 20% down, you're at prime minus 0.55. When you're getting to 25% down, you're at prime minus 0.55. And when you're at 30 and 35% down, you're looking at prime minus 0.75 and prime minus 0.9 respectively. And when we start to get to uninsurable rates, you start to look at prime minus 0.25, which off of that prime rate, which is 6.7%, well, as you can see, it's a pretty high rate to pay. So if you're faced between 6.45 on a variable rate or 5.04 on a fixed rate, well, the answer seems to be pretty obvious which one you should choose. Now, that being said, if you aren't going to hold a mortgage for the full 5-year term and you're pretty sure of that right out of the gate, you need to be very careful of payout penalties, and you'll need to take that into consideration when you go to get your mortgage. Again, more information about that in the book and on the other videos in this channel. I'll link to one at the very end here. Now, moving into discount mortgages. So these are the mortgages that come with a catch. It's just like everything else in life, you get what you pay for. If you drive into a car dealership and you see two vehicles that look the same, are the same model, but are priced differently, there's obviously a difference in the features. And that is also true for mortgages. So when you start looking at discount mortgages, these are the lowest rates you can get in the country. You have to also look at what you're giving up. So they'll have things like the inability to get out of the mortgage unless you sell the house, things like higher payout penalties, things like reduced prepayment privileges. And unless you know exactly what you're getting for that lower price, it probably isn't worth it. And the big thing here, the big reason why I'm encouraging people to avoid discount mortgages, even though if a client comes to us and says, hey, I want that, we'll go get it for them. But the reason why we're encouraging them to avoid these is because if interest rates do go down, and again, with the Federal Reserve pausing in the US, it looks like this may be a possibility. Well, you want to have the ability to get a lower mortgage rate somewhere down the road. And the only way you can do that is if you have a mortgage that you can get out of if interest rates go down. Now, obviously, you may have to pay a penalty, but if you can pay a penalty and save a bunch of money, then it's worth it. But if you end up with one of these discount mortgages that has a clause in it that says that you can't switch to a different lender, well, then you've lost all your negotiating power, and therefore you're pretty much stuck with the rate that you have, even if interest rates go down. So the old saying, date the rate, marry the house. Well, if you get this sort of mortgage, you're not only marrying the house, but you're also marrying the mortgage at least for 5 years until you can have an amicable divorce. From your lender, that is. Now, of course, I believe in transparency, so we show you these rates anyways. So insured mortgages, you're looking at 4.34% for the absolute lowest rate that you can get. At 20% down, you're looking at 4.74%. At 25% down, you're looking at 4.54%. At 30% down, you're looking at 4.44%. And at 35% down, again, you're back into that insured range because 35% down is about the amount of down payment where the bank sees you as almost a zero risk of walking away from the house. So you're getting back into that 4.34% rate that's similar to the rate that you had with an insured mortgage. And then with respect to uninsurable refinances, all of those things, well, because the lenders can't get back insurance on those products, there's no really great discount rates for those types of mortgages. Okay, so now last but not least, moving on to those variable rate discount mortgages. These ones are just the ones that I avoid at all costs because quite often the discount that you're getting is about a cup of coffee a week, but the potential harm in having to lock in at one of these lenders just isn't worth it. But nonetheless, here they are. On a 5-year variable discount mortgage, you're looking at prime minus 1.1. At 20% down, you're looking at prime minus 0.75. At 25% down, you're looking at prime minus 0.75. At 30% down, you're looking at prime minus 0.95. And at 35% down or more, you're looking at prime minus 0.1. Now, with respect to choosing between all of these mortgage options, it's not an easy choice at the moment. Well, it may seem like an easy choice because fixed rates are so much cheaper than variable rates, but all of this comes down to two things now: your risk tolerance and what you plan to do in the future. So when you go to get your mortgage, you need to have a very detailed conversation with the person you're getting it from about your future plans, because your future plans are going to play a big role in which mortgage you choose. And if you don't get this right, you could find yourself in a situation where you have to pay a big penalty and subsequently end up giving a whole bunch of equity to your bank. And this isn't something that is necessary. It's something that can be avoided if you have the right people guiding you through the process of choosing your mortgage. And don't be one of those people who steps over dollars to chase pennies and tries to get the absolute lowest rate and gives up a whole bunch of money somewhere down the road because you ignored the most important pieces of the mortgage, which are the product and the penalty, not the price. And if you want to know more about basic mortgage information, make sure you check out one of these videos here.